Welcome to vTalkInsight, Market Drivers Daily for July 15th, 2026. AI-driven capital expenditure is powering another leg of earnings strength, just as tensions around the Strait of Hormuz keep an energy premium embedded in inflation. Today, the key question is whether robust results from banks, chipmakers, and luxury names can offset rising geopolitical and valuation risks in equities. AI is still the core growth engine for earnings and capital markets, but the narrative is shifting from pure hype to hard economics. Enterprises are discovering that broad experimentation is expensive, with many seeing budget overruns on AI, tokens, and infrastructure while struggling to generate tangible business value. The firms getting the most out of AI are concentrating on a small set of end-to-end processes rather than sprinkling pilots everywhere. Focusing on 4 to 6 critical workflows is being cited as a way to capture the bulk of potential value, which underscores how important strategic discipline has become. That discipline is forcing organizational change. Successful adopters are rethinking structures, incentives, and skills so that AI actually lives inside daily workflows rather than in side projects. Consulting firms offer a good example. Even as they trim indirect roles, they are adding client-facing staff and arming them with AI agents, signaling a model where human expertise is amplified rather than replaced. Large financial institutions like BNY Mellon are also reporting near universal AI upskilling and broad workflow integration, framing AI as a long-term productivity enabler rather than a quick cost cut. On the corporate side, companies such as Zoom are leaning into this shift by combining organic development with acquisitions and strategic stakes in leading AI providers, using partnerships with firms like Anthropic to upgrade product quality while tightly managing AI-related costs. On the Capex side, AI is now clearly hardware-heavy. Major tech groups once seen as asset-light are committing to massive long-duration investment in chips, data centers, and power. ASML sits at the center of that build-out. It has raised its sales outlook for the second time this year, beaten even the most optimistic revenue estimates, and is planning to expand production capacity, with demand visibility stretching through 2028. Semiconductor sector earnings have been underestimated by roughly half for 2026, and ASML's guidance upgrades are reinforcing the idea that AI infrastructure demand is both larger and longer lasting than many models assumed. That strength is feeding through to equity indices from European tech to Korea's Kospi and into U.S. equity futures. But the physical build is straining infrastructure. A surge in data center construction is driving labor and material shortages, lifting construction costs and crowding out other projects, while power and water become binding constraints. New York State's moratorium on hyperscale data centers, after grid supply costs jumped more than 60%, is a visible warning that local politics and infrastructure limits can slow the AI rollout. In contrast, China is pushing ahead with around 100 gigawatts each of new nuclear and solar capacity to support its AI ambitions, highlighting a growing policy divergence. This Capex wave is also blurring the inflation outlook. Early stages of AI adoption are described as inflationary, as firms ramp spending on hardware, power, and specialized labor, and as data center construction lifts local input costs. Electronics prices remain elevated, and AI-driven demand is helping keep memory prices high, even as energy costs tied to data centers feed into broader utility bills. At the same time, business investment data show high-tech spending surging, with equipment investment accelerating as companies race to build AI infrastructure. Over a 2 to 3 year horizon, however, many see AI as ultimately deflationary via productivity gains and lower unit labor costs. Recent U.S. productivity growth, the gradual easing of wage pressures, and evidence of AI-supported efficiency gains at firms like BNY Mellon are used to argue that central banks may be able to stay patient while growth holds up. The tension is that AI has not yet fully relieved structural inflation in areas such as electronics, and power constraints could keep parts of core inflation sticky even as headline measures benefit from productivity improvements. Market behavior reflects this mix of optimism and constraint. AI-related equities are still supported by strong earnings and ongoing Capex, and capital markets remain wide open for companies tied to the AI ecosystem, from equity issuance to sizable bond deals. But expectations are high and positioning is crowded. We have already seen sharp unwinds in some AI trades, widening credit spreads for highly levered tech names, and underperformance in parts of the software complex, even as chipmakers rally. In private markets, median revenue multiples for AI companies around 25 times underscore the risk of valuation compression, especially as more high-profile IPOs approach and public market scrutiny intensifies. Investors are becoming more demanding about return on investment, pushing back on indiscriminate AI, token, spending, and favoring business models with durable earnings and hard-to-replicate positions along the value chain. Overlaying all of this is a growing political and social dimension. Rapid AI adoption without credible plans to protect jobs is seen as a recipe for regulatory backlash, potential recessionary pressure, and even social unrest. Concerns about rising electricity bills and labor displacement are already fueling moratoriums and policy proposals, including controversial ideas for government equity stakes in AI companies. At the same time, there is bipartisan momentum to ensure American workers share in AI gains through updated infrastructure, social insurance, and retraining incentives. For now, most investment firms keep AI usage to lower-stake tasks like data gathering and summarization, citing transparency and auditability as prerequisites for trusting models with portfolio-level decisions. The expectation is that as reasoning capabilities improve, AI will migrate further into high-stakes processes. Pulling this together, the sustainability of the AI trade now hinges on three things: whether hyperscalers maintain their Capex plans, how quickly infrastructure and regulatory bottlenecks are resolved, and whether earnings can keep pace with rich valuations. With that backdrop, we turn to the other major swing factor for inflation and risk appetite: geopolitics and the energy complex. Geopolitics around the Strait of Hormuz and the Russia-Ukraine conflict continue to anchor a structural premium in energy prices, even as headline moves in crude remain contained compared with the risks on the table. Over the past few days, the situation in Hormuz has moved from strained to openly dangerous. Shipping activity has slowed sharply. Some vessels are going dark or staying stationary, and the International Maritime Organization now deems the strait unsafe for transit. Escalating U.S. military strikes on Iranian assets, the prospect of a naval blockade, and threats to target energy infrastructure are all feeding into higher risk premia for oil and refined products. Brent has been trading around the mid-80s, up roughly 13% on the week at one point, while West Texas Intermediate has pushed above $80. European natural gas has also climbed to multi-month highs, helped by Middle East tensions and a regional heat wave, just as storage refills begin, raising energy cost and inflation risks into the coming winter. These moves matter because the burden is uneven globally. Sustained high oil and gas prices are likely to hurt Asian and European economies more than the United States, given their heavier dependence on imported energy. Recent commentary highlights how elevated crude is already acting as a headwind for European equities, offsetting the support coming from strong U.S. bank earnings and the broader AI trade. UK officials have warned that repeated shocks from the Middle East are testing the country's economic resilience. Policy uncertainty adds another layer. A reversal by the U.S. administration on proposed shipping fees through Hormuz underlines how fluid the policy stance remains, injecting additional volatility into oil and shipping markets. At the same time, NATO allies have pledged around €70 billion per year for Ukraine over the next 2 years and are stepping up joint exercises and political engagement, all designed to signal durable European support even as questions grow about the reliability of U.S. backing. Internal divisions within Iran and a U.S. strategy that appears set on maximizing pressure ahead of midterm elections point to a base case where the conflict intensity increases over the next couple of months rather than easing quickly. For inflation and rates, energy remains the key swing factor. Recent U.S. inflation data have taken a July Federal Reserve hike off the table, but persistent turbulence in the Middle East and oil stabilizing in the mid-80s keep alive the possibility of renewed tightening risk later in the year. Even where spot prices are not surging, a higher floor for energy costs raises input prices across food and fuel, complicating the disinflation narrative and capping the room for bond yields to fall. European and UK markets look particularly exposed, given their larger energy import needs and sensitivity of inflation expectations to gas and diesel. Sector-wise, the current configuration points to a potential rotation path. If the U.S.-Iran confrontation escalates or oil makes a durable push toward 90 and beyond, market leadership could swing away from high-growth AI beneficiaries back toward more defensive and high-dividend segments. Defense is another locus of potential change. European defense stocks, which have lagged recently, could find support from sizable new NATO commitments and growing procurement pipelines, while defense-related semiconductor names are positioned to benefit from multi-year weapons and systems upgrades. Despite these risks, markets are not trading a full-blown energy crisis scenario. Oil and gasoline flows through Hormuz remain sufficient for now. Alternative routes have been relatively effective, and weak Chinese demand is helping offset some upward pressure on crude. The futures curve shows only a modest risk premium, and retail fuel margins are absorbing part of the volatility in global prices, which dampens the immediate pass through to U.S. consumers. Food inflation has also yet to reflect the latest energy moves in a meaningful way. U.S. equities, meanwhile, remain resilient, with the S&P 500 slightly higher alongside strong earnings for major banks and only limited moves in Treasury yields. From here, the key watch points are shipping conditions and insurance costs through Hormuz, the behavior of Brent around the $85 to $90 range, and European gas prices as storage builds. On the political side, any credible move toward negotiations, or conversely a clear shift toward targeting Iranian civilian infrastructure, could quickly change the market narrative. Against that geopolitical backdrop, the durability of the current equity rally increasingly depends on whether strong earnings can keep offsetting higher energy costs and lingering inflation risks. Earnings season is coming through with broad-based strength, reinforcing the idea that the equity story has widened beyond a handful of AI champions. Across the S&P 500, 10 and 11 sectors are expected to deliver positive results, with technology, energy, and financials leading the gains. Market breadth is improving, with roughly two-thirds of index members now trading above their 50-day moving averages and equal weight earnings revisions turning meaningfully higher. At the index level, strong corporate profit growth and the fastest margin expansion in decades are helping to justify elevated valuations, even as debate grows over how much further multiples can stretch from here. Within technology, the standout continues to be semiconductors and related equipment. ASML has delivered another powerful signal, beating earnings expectations, raising full-year sales guidance for the second time this year, and outlining capacity expansions to meet surging demand for AI-oriented chip-making tools. Its latest outlook now exceeds even the most optimistic prior forecasts by close to $9 billion, and management confidence extends through at least 2028, underlining how durable the current AI hardware cycle appears. Analysts note that 2026 sector earnings had previously been underestimated by around 50%, and a succession of upgrades is feeding a tech-led rally that extends from European semis to Asian foundries and U.S. equipment names. That said, the sharp sell-off in companies like IBM on weak spending guidance is a reminder that not every tech name participates equally. Investors are differentiating between firms tied directly to AI infrastructure and those more exposed to delayed or squeezed software budgets. The financial sector is also printing exceptionally strong numbers. Major U.S. banks have reported record quarterly profits, with equity trading revenues hitting all-time highs. Goldman Sachs alone has surpassed $7 billion in equity trading for the quarter, while the top 5 banks together generated around $50 billion in equity trading revenues, more than a third of last year's full-year total in a single quarter. Morgan Stanley is expected to cross $25 billion in trading revenue, pointing to a rising tide rather than a simple market share shift. Asset managers are riding the same wave. BlackRock has delivered a sizable earnings beat, with earnings per share far ahead of expectations and net inflows of nearly $192 billion, taking assets under management to roughly $5.3 trillion. BNY Mellon has reported back-to-back record quarters in revenue and in assets under custody and administration, helped by 10 consecutive quarters of positive operating leverage and targeted investment in AI and product innovation. Capital markets are highly receptive to AI-related issuers, with equity underwriting activity more than doubling at Goldman Sachs, record merger and acquisition pipelines, and heavy debt issuance from AI-linked firms, even as credit spreads for some hyperscalers widen modestly. The nuance is that not all of this strength is translating into share price gains. Several banks have seen muted or negative reactions as investors focus on rising cost guidance and the possibility that today's exceptional trading and deal environment may not be sustainable. Outside tech and finance, selective consumer names are quietly reinforcing the picture of resilient high-end demand. Richemont has reported sales that nearly doubled expectations, with about 20% growth in the latest quarter driven by strong U.S. appetite for Cartier jewelry. Its jeweler division posted roughly 24% growth, and the strength is spilling over into peers like Hermes and LVMH, supporting outperformance across European luxury stocks. In the UK, housebuilder Barratt has seen its share price jump more than 4% after announcing a buyback and confirming profits in line with expectations, easing some near-term worries around the property sector despite ongoing cost and demand challenges. Putting this together, earnings are validating a constructive backdrop while also raising the bar for future surprises. The combination of strong results from semis, banks, asset managers, luxury, and select cyclicals suggests that the rally has more breadth than headline indices alone imply. The open questions are whether hyperscalers maintain AI Capex at levels that sustain the semiconductor and capital markets boom, how long trading and issuance volumes can stay at record levels, and whether energy and inflation shocks chip away at margins later in the year. Those dynamics will shape whether equity leadership stays concentrated in AI and a handful of financials, or rotates more decisively toward a broader set of sectors in the months ahead. To wrap up, AI remains the central earnings and macro engine, but the story is becoming more selective as infrastructure bottlenecks, regulatory pushback, and valuation pressures emerge. Geopolitical tensions around the Strait of Hormuz and Ukraine are keeping an energy premium embedded in inflation, complicating the rate path even as U.S. equities hold up. At the same time, this earnings season is confirming robust and increasingly broad profit growth, led by semiconductors, banks, asset managers, and high-end consumer names, though elevated expectations and rising cost guidance are capping some of the upside. Watching AI Capex signals, energy prices, and the trajectory of margins across sectors will be critical for understanding how equity leadership and cross-asset pricing evolve from here. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.